You just closed 3 winning trades in a row. Your account is up 15%. Every decision feels effortless, like you've finally cracked the code. The market seems to move exactly where you predict. This is the moment most traders increase their position size, convinced they've entered a new level of mastery. But here's what Wyckoff observed in every market cycle. This feeling of invincibility appears at precisely the wrong time. The composite operator knows when you feel most confident, because that's when the crowd becomes predictable, and predictable traders become liquidity. Picture this: you've just executed 5 consecutive profitable trades. Your chart reading feels supernatural. You glance at a setup and instantly know buy here, sell there. No hesitation, no doubt. Your account equity curve points straight up like a rocket. You're texting screenshots to friends, perhaps even considering quitting your day job. Every candle seems to whisper its secrets directly to you. But let me ask you something uncomfortable. When did you last check your trading journal? When did you last measure your risk to reward ratio before entering? When did you last wait for all 3 confirmation signals you promised yourself you'd never trade without? Here's what's actually happening, and I've observed this pattern destroy more talented traders than any market crash ever could. That feeling of effortless accuracy. It's not mastery emerging. It's your discipline disappearing. You've stopped following your method and started following your gut. You've replaced your systematic process with what feels right. And feelings, my friend, are the composite operator's favorite tool to separate you from your capital. The professional trader, the one who consistently extracts money from the market year after year, operates like a machine. He doesn't feel good or bad about his trades. He doesn't get excited when he's right or devastated when he's wrong. He follows his established method with cold precision. He checks his volume analysis. He waits for his specific price patterns. He measures his risk exactly, every single time, no exceptions. But the amateur starts making money and suddenly believes he's transcended the need for rules. His recent success becomes evidence that he's got it now. He spots a setup that's 80% similar to his criteria and takes it anyway because he feels confident. He risks 3% instead of his usual 1% because this one feels like a sure thing. He ignores diminishing volume because the price action looks right. He's trading on emotion disguised as intuition. You want to know the truth? Intuition in trading only works after you've logged 10,000 hours of screen time following a strict method. Before that, what you call intuition is simply your nervous system getting dopamine hits from recent wins. It's neurochemistry, not market wisdom. So here's your reality check. The moment trading feels easy is the moment you need to slow down, not speed up. Pull out your trading plan, the one you wrote when you were rational and objective. Read it line by line. Are you following it? Every rule, every checkpoint. If you've deviated even slightly, you're not operating as a professional. You're gambling with better than average luck. The market will let you win while you're breaking your rules. It's generous that way at first. But it always, without exception, collects payment later. And the bill always comes when you've sized up your positions based on false confidence. Stay mechanical. Stay disciplined. Your feelings are not your edge. Your method is. You've been watching that stock for weeks. The breakout finally happens. Every technical indicator aligns perfectly. MEMAD crossed. RSI strong but not overbought. Volume surging. The trading forums are buzzing. Twitter's financial corner is filled with rockets and moon emojis. Even the skeptics are capitulating, posting, "Okay, I'm in." You place your order with absolute conviction. Everyone sees it. Everyone agrees. This is the trade. 3 days later, you're staring at a 12% loss, wondering what happened. The breakout failed. The volume dried up. The price reversed violently. You check the forums. Everyone's confused, angry, claiming manipulation. But here's what you need to understand. It wasn't manipulation. It was mathematics. Let me show you how the professional money operates, because they're not trading the same game you think you're playing. While you're looking at patterns and indicators, they're looking at you. They're watching order flow. They're measuring retail sentiment. They're counting how many traders just became certain about the same direction, and when that certainty reaches critical mass, that's their signal, but not to join you. To position against you, think about the mechanics of market movement. Prices rise when buying pressure exceeds selling pressure, but who's left to buy when everyone who wants to be long is already long? Who provides the fuel for the next leg up when the crowd is fully committed? Nobody. You've reached what I call the point of maximum participation and maximum vulnerability. The composite operator knows this. They've been accumulating their position while you were waiting for confirmation. Now, while you're finally convinced and entering, they're preparing their exit. Your certainty is their liquidity. This plays out every day in modern markets with clockwork precision. Bitcoin breaks 70,000 and crypto Twitter declares victory. 2 weeks later, it's at 62,000. A tech stock gets mentioned on CNBC's halftime report with everyone bullish. It peaks within 48 hours. An options trader posts massive gains on Reddit's trading forums. Thousands pile in the next morning. The setup fails. The pattern never changes because human nature never changes. The professional understands something crucial. The crowd doesn't get certainty at the beginning of moves. They get certainty at the end of moves. Retail traders need confirmation. They need proof. They need validation from others. So they enter late after the evidence is overwhelming. And overwhelming evidence means the easy money has already been made. Here's your trading survival guide. When you feel certain, when the trade feels obvious, when everyone around you agrees, that's not your green light, that's your yellow light. Pause. Check where you are in the price structure. Are you buying the breakout at all-time highs after a 40% run? Are you shorting after 3 consecutive red days when fear is peaking? If your conviction comes from consensus, you're likely providing the exit liquidity for someone smarter. The composite operator doesn't follow the crowd. They fade it. And they do it profitably, consistently, because the crowd's certainty is the most predictable pattern in all of market analysis. Trade the opposite of obvious. Your last 7 trades closed green, 7 in a row. Your account is up 28% this month. You're reviewing your next setup, a textbook spring pattern with beautiful volume characteristics. Your standard risk is 1% of capital per trade, which means a 1,000 position based on your 100,000 account. But something whispers in your mind. You're on fire. You clearly see the market right now. Why risk only 1,000 when you could risk 5,000 and really capitalize on this hot streak? You increase your position. 5 times your normal size, the trade triggers. Within 2 hours, the setup fails. Stop loss hit. You just lost 5,000, erasing the gains from your last 5 winning trades combined. Your 28% monthly gain just became 8%. 1 trade, 1 decision, devastation. Now you're sitting there replaying the mistake, wondering how you went from feeling like a genius to feeling like a reckless gambler in the span of a single trading session. Here's the brutal mathematics of position sizing that most traders learn too late. Your risk management rules aren't suggestions for normal times. They're insurance policies designed specifically for moments when you feel invincible. The composite operator, the professional money that moves markets, doesn't win because they're right more often than you. They win because when they're wrong, it costs them pennies. When you're wrong after sizing up, it costs you dollars. Let me show you the numbers that expose this trap. If you risk 1% per trade, you can be wrong 20 consecutive times and still have 82% of your capital intact. The market can humble you repeatedly, and you survive to trade another day, but risk 5% per trade, 7 consecutive losses, which happens to every trader eventually, and you're down 30%. Now you need a 43% gain just to break even. You've transformed trading from a probability game into a survival game. But here's the psychological poison that makes this worse. Winning streaks don't just tempt you to increase size. They make you believe you've evolved past your rules. Your brain, flooded with dopamine from consecutive wins, starts rewriting your personal narrative. Those 1% risk rules were for the old me, the trader who didn't understand market structure. I'm different now. I've leveled up. No, you haven't. You've just experienced statistical variance in your favor. The market gave you a favorable sequence. It happens. It's normal. It's also temporary. The professional trader knows that winning streaks and losing streaks are both inevitable parts of probability distribution. He doesn't interpret his wins as evidence of special ability. He interprets them as exactly what they are, his method working within normal variance. Here's your safeguard, and I'm begging you to write this down. Your position size should be inversely related to your confidence. When you feel like you can't lose, that's when you cut your risk in half, not double it. When your equity curve is spiking upward, that's when you become more conservative, not more aggressive. The trader who survives long enough to compound wealth understands this counterintuitive truth. Protecting your capital during winning streaks is more important than growing it. Because the losing streak is coming, it always comes. And when it arrives, your survival depends entirely on whether you preserved your discipline when you felt unstoppable. Risk small, win big, survive long. You open your trading platform Monday morning and everything just clicks. The charts make sense. The setups appear obvious. You take 3 trades before lunch, all winners, no struggle, no second guessing. No need to review your checklist or consult multiple timeframes. Trading has become easy, comfortable, almost automatic. You lean back in your chair, coffee in hand, watching the profits accumulate. This is what mastery feels like, right? This is the breakthrough every trader chases, the moment when reading the market becomes as natural as breathing. But let me stop you right there, because you're standing at the edge of a cliff you don't even see. Trading should never feel comfortable. Ever. The moment it does, you've stopped doing the work. You've stopped reading the tape. You've stopped analyzing the relationship between price and volume. You've stopped questioning whether the rally you're buying is genuine accumulation or merely a dead cat bounce in a larger distribution pattern. Comfort means you're operating on assumptions, and assumptions in the market are financial suicide. I built my entire methodology on one core principle: effort. Constant, disciplined, unrelenting effort to read what the market is actually doing versus what you want it to be doing. Every morning, you should be examining volume spreads. You should be identifying whether smart money is accumulating or distributing. You should be mapping support and resistance with precision. You should be asking, is this spring legitimate or a bull trap? Is this upthrust a reversal signal or just noise before continuation? This work isn't optional during some trades and unnecessary during others. It's the foundation of every decision, every day, regardless of how your recent trades performed. But here's what happens when you get comfortable. You start skipping steps. You glance at a daily chart and think, I know what this is. You see a breakout and immediately assume it's valid without checking if volume confirms accumulation. You stop drilling down into the hourly time frame to see if the composite operator is creating spring setups to shake out weak hands. The professional trader I'm describing, the one who consistently extracts money from this market, treats every trade like a detective treats a crime scene. He assumes nothing. He verifies everything. He checks his assumptions against the evidence. When volume contracts during a rally, he doesn't ignore it because the price is going his direction. He notes it. He adjusts his thesis. He prepares for the possibility that he's watching distribution disguised as strength. You want to know why most traders fail during their comfort phase? Because the market changes phases while they're on autopilot. They're buying markup momentum while professionals are already distributing. They're holding through re-accumulation phases because they've stopped reading the signs that accumulation has ended. They miss the transition from spring to upthrust because they've stopped doing the comparative analysis that reveals these shifts. Here's your discipline. Every single trade requires full analysis, no shortcuts, no assumptions. No, this looks like that other trade that worked. You check volume on every time frame. You verify whether buying or selling pressure is actually present. You confirm the phase, are we in accumulation, mark-up, distribution, or mark-down? The market rewards effort. It punishes comfort. Stay uncomfortable. Stay analytical. The moment you relax is the moment you become the liquidity someone else needs. Your trading account just hit an all-time high. You've made more money in the past 3 weeks than the previous 3 months combined. Every position you touch turns to gold. The Tesla calls printed. The crude oil long worked perfectly. Even that speculative biotech play, the one you almost skipped, delivered a 40% gain in 2 days. You're texting your spouse about that vacation you've been postponing. You're calculating how many more months like this until you can trade full time. Life is good, trading is good. Everything is finally working. Then you check the broader market. The S&P 500 has rallied 18% in 8 weeks. The volatility index is at multi-year lows. Margin debt just hit record levels. Retail trading volume is exploding. Every CNBC segment features another story about everyday people quitting their jobs to day trade. The sentiment surveys show bullishness at 85%, levels rarely seen outside major market tops. Do you see what's happening here? Your personal euphoria isn't random. It's synchronized with a market-wide climax. Let me show you the pattern that repeats in every cycle, from the 1920s to the 2021 meme stock mania to whatever bubble is inflating right now. Markets don't top when everyone is cautious. They top when everyone is finally convinced. When the skeptics capitulate. When the last holdouts jump in. When your performance feels best because even your mediocre trades work. Because everything is rising on a tide of indiscriminate buying. This is the composite operator's masterpiece. They've spent months accumulating positions while you were scared, while the market was chopping, while everyone was calling for crashes. They accumulated in the valley of doubt when prices were cheap and sentiment was terrible. They've marked up those positions through strategic buying, creating the rally you're now finally participating in. And now, while you're experiencing your best trading month ever, they're quietly distributing their inventory to you at premium prices. Your euphoria is their exit signal. They're not measuring their success by how they feel. They're measuring it by whether they can unload massive positions without crashing the price. And they can, because you and thousands of traders like you are buying with both hands, convinced you've figured it out. Providing the liquidity they need. Look at the structure. Are you buying breakouts to new highs after a 40% sector rally? Are your best trades coming in the most crowded names, the ones everyone's talking about? Are you entering positions that require continuation of an already extended move to profit? If yes, you're not early, you're late, dangerously late. Here's the harsh reality about timing. Retail traders don't get their best months at the beginning of bull markets. They get them at the end. Why? Because beginnings require courage when the market looks terrible. Endings provide confirmation when the market looks perfect. You feel best when conditions feel safest, and conditions feel safest right before they change. So when your account is screaming higher and every trade works, and you feel like you've achieved trading mastery, do this: stop. Review your positions. Check where we are in the market cycle. Examine volume characteristics. Is this rally on expanding or contracting volume? Look at the weekly and monthly charts. Are you buying the 7th or 8th week of vertical price action? Then ask yourself the professional's question. If I'm feeling this good, and the crowd is positioned the same way I am, who's left to buy and push this higher? The answer determines whether you're compounding wealth or providing exit liquidity. Trade the cycle, not your feelings. So here we stand at the end of this analysis, and I need you to grasp one final uncomfortable truth that separates the professional from the amateur. Everything you've been taught about success is backwards in this business. In every other profession, medicine, law, engineering, athletics, getting better means things become easier. The surgeon's hand grows steadier. The attorney's arguments sharpen. The concert pianist plays Rachmaninoff without conscious thought. Mastery brings comfort. Excellence brings confidence. Success brings certainty, but trading is the inverse profession. The better you become, the more uncomfortable you should feel. The more successful you get, the more vigilant you must remain. The clearer the opportunity appears, the harder you should question it. Think about what we've covered. Your best feelings signal overconfidence, so you must distrust your confidence. The crowd's certainty marks their vulnerability, so you must fade consensus. Winning streaks tempt position size errors, so you must become more conservative during success. Comfort indicates you've stopped analyzing, so you must force yourself to work harder when things feel easy. And your peak performance often aligns with market extremes, so your greatest months should trigger your greatest caution. This is the professional's paradox. You must become the trader who tightens discipline when others relax it, who risks smallest when feeling most confident, who works hardest when trading feels easiest, who questions most deeply when answers seem obvious, who steps back when the crowd rushes forward. The composite operator, that professional money moving billions through these markets, doesn't beat you with superior predictions. They beat you with superior discipline. They win because they never stop reading the tape. They never confuse a winning streak with invincibility. They never mistake crowd certainty for opportunity. They never let comfort replace analysis. Your path forward is clear but difficult. Learn to recognize your emotional peaks as trading signals. When you feel invincible, cut your risk. When everyone agrees with you, reconsider your position. When trading feels natural and easy, double your analytical effort. When your account hits new highs during a parabolic market move, take chips off the table. The market will always offer you the choice: you feel good or make money consistently. The amateur chases the feeling. The professional chooses the process. Be the professional. Stay uncomfortable. Trust your method, not your emotions. And remember, the composite operator is always watching, always waiting for the moment when your confidence makes you predictable. Don't give them that moment. Trade with discipline. Survive with humility. Profit with patience. That is the Wyckoff way.